Good morning, YouTube. I hope you've all had an amazing week. When I first began this journey, one of the first questions I asked myself was, how am I going to live off these dividends? Today, I'm going to answer that and give you tips on what pitfalls to avoid as a dividend investor. When building your dividend portfolio, you want to stay ahead of inflation so it doesn't begin to lose value. If you aim for a 4% return, this will hedge your bets against it, which is roughly between 2–2.5% a year. If you've done your research and picked well-established blue chip players, then that 4% won't stay 4% for long. With regular dividend increases from dividend kings and aristocrats, your portfolio could easily appreciate another 3–4% a year, making your returns closer to 7%. It's pretty common to use those dividend king/aristocrat lists to help kick off your research into another investment opportunity. If you don't know what a dividend king aristocrat is, check out my video on that topic. However, there is a fine line here. If you pick a pair that is less than 1%, sure, it's a safe and protected dividend, but over time, it could be swallowed up by the ever-growing money monster, inflation, especially if Papa Powell continues to print money like there's no tomorrow. On the other hand, if you continually chase high-yielding dividend pairs, think over 4%, those aren't as safe and have less room for growth and appreciation. And extremely high-yielding stocks could be indicative of a cut or a struggling company. For example, let's say a company valued at $100 a share, yielding a healthy 4% dividend sounds wonderful. I'm all on board for that. That same company who was just found to have fudged their research and can't really run a comprehensive blood analysis with a single finger prick's worth of blood are now filing bankruptcy. You haven't done any research, so the $95 price drop was completely off your radar. Now we have a $5 stock, but with a dividend yield of 80%. Whoa, let's get it, 80%. To some, that 80% looks like gold, but for someone who has done their research, me or you, in this case, a simple Google search of the company would stay as far away from this company as they possibly could. If you purchase two companies, one with a lower yield but a better growth rate, then another company with a higher yield but a slower growth rate, you can still average out a better rate than inflation. This could be called diversification. If you are investing into stocks, you have to be prepared for turmoil. This is necessary if you aren't using bonds or a fixed income source. Experiencing the previous few months in the market could do a better job of explaining what I mean better than I could hope so. Let's just say it was a wild roller coaster. But overall, I'm back up and better than I was from before the Black Swan event crash of 2020. You have to stick to your guns. I've mentioned this many times before, that you must stick to your plans. If you've done your due diligence, those blue chip long-term payers you've picked will help cushion the blow of most market crashes. If you were concerned with conducting your own research, ETFs might be your bag. In this case, a bag containing many companies to spread out your risk. They range from stock ETFs containing dividend aristocrats, such as the Noble ETF, Retail Investment Trust, broad stock market ETFs such as VTI, or broad S&P 500 ETFs, VOO. Those last two are the most diversified, some containing up to 3,000 holdings, but they will have lower yielding dividends. It's not all sunshine and rainbows though, there are risks. When you put your money into the stock market, there are never any guarantees you will make anything. History shows otherwise, but history is not the future. During the crash a few months ago, I had a few payers cut. They were mostly oil, travel, and mall investments. They were cut for obvious reasons. If you go all in on dividend stocks for retirement, you would be concentrating completely in one asset class and investment style. Most advice calls for retirees to keep their equity exposure between 20 and 75% of their overall portfolio, with bonds and cash making up the rest. I'm slowly investing into bonds to offset some of those risks. Your ultimate goal should be to maintain a minimum standard of living and keeping your nest egg intact. If you concentrate all your assets into one or two sectors, an interest rate increase could decimate your holdings. I'm thinking REITs on this one. Had I not been diversified and only owned oil and travel dividend payers, even those dividend kings, I would have lost it all during the pandemic sell-off. Staying diversified with your investment portfolio and not depending solely on dividends during retirement will help keep your nest egg safe and growing. I hope this was as informative to you as it was me. Thank you so much for watching, and if you made it this far, it means you liked what you saw, and wouldn't you consider giving me a subscription? Subscribe, and definitely liking this video. Comment down below how you are planning on retiring. Thanks again, and may all of your investments be a success.